Lawrence McComey, Savannah Mudd. Take it away.
Thanks, Marla. Hi, everybody. We do have a lot to cover today, so I'm going to jump right in. The first thing that I want all of you guys to think about when you're thinking about acquiring and financing commercial real estate is a couple main questions, which is first, will the property need to be renovated? A lot of property on the market today needs work. So that's something always to consider. And we're going to talk through today a lot about the renovation process. The other question is, will you need to lease any space to third-party tenants? So that's a question to ask. I know we have a lot of small business owners on the webinar today who are looking to acquire space for their business, but sometimes we see small business owners find a space that's maybe a little too big for them, or maybe it has apartments above and they want to be leasing some of it out and not all of it will be occupied by their business. So that's something to think about, and it does add another complication to the project that we'll talk through today. Obviously, there's also just developers who want to lease the whole thing out to third parties. And then, the other thing to think about as we go through today is, what are your areas of expertise? You might run a business, you might have a lot of knowledge of construction, maybe you have a lot of connections with real estate brokers. Think about what you really are good at and make sure that that's something that you could take on in this project as we talk today through the roles that you would take. And then obviously think about the topics that you know the least about and that you might need to hire expertise for. And then the last and maybe the most important to me as a lender, which is, what income sources are you going to use to pay the interest and principal of a loan, right? So if you are thinking about acquiring a space and taking out a loan, you're going to get, okay, what are the loan terms from the lender? But then you're going to say, well, how do I pay for those? Am I paying for them out of my business revenue? Am I leasing? Again, am I getting this in lease revenue? So we're really going to talk through that today. And one of the attachments that we sent out yesterday was a pro forma. So we'll talk through that as well. Okay, so let's get started. You might be surprised, but as a lender, I actually want to know every single thing about the project. And that's really how we look at it to underwrite a loan. So we're going to go through all the pieces of really project managing a real estate development project today, and understanding that not all of them are that complex, but we're going to kind of talk about the most complex case so that you know all the parts. The person who's really managing the project we call that the developer, and that could be you. Serving in that role. And the thing about it is, you're really like a train conductor. There are all these aspects of a project, and you have to keep them all on the track, at the same, not running into each other, everything, all of the times have to be kept. That's really the job of the developer. So we're going to talk through all of that. It's a tough job because there are so many aspects of the project that have to be moving at the same time. And you have to kind of keep them on the track. So the first one we're going to talk about is forming your team. Okay, so pretty much all projects need to have a developer, even if that's just you managing the project. And then, think about who's going to invest in it, who's going to bring the equity for the project. So every, project needs a down payment. Who's going to bring that? Do you have that, or do you need to bring in other investors that you might know to help you bring that in? And so obviously those are conversations you want to have. We see a lot of projects where people are, forming joint ventures with someone who might have expertise in an area that they don't have expertise in, or just a limited partner who has money that they want to contribute to the project. Obviously, you want to have legal representation, but you want to think through, like, what exactly do you need legal representation on? So there's obviously acquiring a property. And for those of you who attended our series last week, we had an attorney on, and she's really focused on, the real estate. You might need a lawyer that also is well-versed in loan documents and can advise you on that. And then, the other part is, what about leasing documents? If you're going to lease to tenants, you might need a lawyer to help you, draft those documents and negotiate them for you. For acquiring, you need a title agent. PIDC could always recommend one to you if you don't have a connection to a title company. And then if there's renovation needed, you're going to need an architect and general contractor to do that for you. So an architect is really, depending on how large the project is, there might be initial drawings, but really at the end of the day, you need somebody to do your permit drawings that you could submit to the city, and enable you to get your permits. And then your general contractor is really your one that's gonna, take on the construction work. They have to be licensed as a general contractor in Philadelphia, and they also can hire subcontractors under them to take on work that they might not do. So you might have a general contractor who's, they're licensed also to do electrical work, and so they do the electrical work, and maybe they do, maybe they can do plumbing, but then they need to hire subcontractors to do, something else in the project. So that's something to consider. And then, things that aren't needed on all projects, but depending on the complication of your project, some projects require an owner's representative. This is a person that can actually manage the general contractor for you. So if you, and this often happens with, sometimes we do large projects with nonprofits, where they're taking on, a massive new headquarters space. They don't have somebody on their team that can devote their full day, their full-time position to managing the construction project. So they hire an owner's representative that can speak the language of construction, can really, navigate the situation between the architect and the contractor, and they can represent your interests so that you're not, overpaying, what's a value, engineering and what's not, and all that kind of stuff. So that's something that sometimes Lawrence and I recommend if the project is big and the organization doesn't have somebody in-house. Obviously, there's consultants. There's so many different types of consultants, so it kind of depends what you want, but there's definitely consultants that help with special financing programs. There's obviously consultants that would assist you in your environmental reports or environmental work if you needed to take on that. A broker could sometimes be useful if you need to find tenants. So we see a lot of clients use a leasing broker. And then, title agent was on the top. Sorry, that shouldn't be there. Okay, so the next part is to find your occupants. So I talked about, this is just assuming that you need third-party tenants. Obviously, it's possible that it just might be your business, and I get that. Even if it's just your business, PIDC is going to want to see that you have a signed lease. So typically, you would own the property, and that was covered last week, in maybe a special purpose entity that you create just to own the property. That's not your business. And then you would sign a lease between that special purpose entity and your business to occupy the space. So even in that case, you're still thinking about a lease, and you're still thinking about what the lease rate would be. Like, you might want it to be a market rate lease. So then you would need to know, well, what's the market rate in this area for this type of space? So this is kind of talking about, like, what are the rates? What are the trends? You might want to talk to other people, other businesses in your area to see what they're paying. You might want to talk to brokers. If you're going to be renting the space to, a third party, you might want to see, like, well, what kind of amenities are out there? What do people really want to see? Do they need shared spaces? On the residential side, you might want to know what the finishes are that are in the market today. So that's all important information, when you're thinking about who will occupy your space. PIDC will want to see that you have letters of intent signed with prospective commercial tenants. So this isn't residential tenants, but for any commercial space, for any business that's going to occupy, PIDC will want to see that you do have letters of intent before we start the underwriting process. So that is important. And that letters of intent should outline, basically, it's just, it's a letter that says, this entity wants to lease from you, and they will pay this rental rate with this for this length of time. This is how much fit out you will provide, or that they will provide. I mean, it can be sometimes very challenging to negotiate how much work each party is going to do. So you think about, like, does the tenant want to move into the space ready to go? Do they want to have bathrooms there for them? Or is that something you need to provide? There's all sorts of levels of fit out and also, the range of negotiations that can take on. So that's something that we would want to see, that you're in negotiations with those tenants and talking to them about that, type of space and who will be doing what. We usually like to see that really outlined once you get to the lease negotiations. Obviously, then you have operating expenses. How much will they pay? Do they have a base rent? Do they have, are they paying operating expenses on top of that? Who's paying utilities? Do they have to reimburse you for what we call common area charges? For instance, like, is there snow removal for the entire building, and you will want everyone to share in that? So that's something, again, to think through. And an attorney that knows leasing could help you through those terms. But you really want to talk to your tenant about what their expectations are of that space. By the time the project closes and we close on financing and you acquire the space, PIDC really wants to see that you have a lease signed before we're going to provide, typically before we provide financing, because we want to see that you have that revenue in place. And we'll get more to that when we talk about the pro forma. The next area is the property due diligence. I'm not going to talk a lot about this because the whole session last week was, on property due diligence, but just going to touch on, and I put a few resources in orange, but I think more were covered last week. So I'm just going to, touch on them a little bit. There are obviously internet searches where you can find a lot of information. Philadelphia specifically, atlas.phila.gov has a ton of information on different properties. And then if you're taking on a large project or just don't understand the zoning and permitting process in Philadelphia, we definitely recommend that you reach out to the Philadelphia Division of Development Services. They have a team at the city that really is just there to help you through the permitting process, and they can just explain what you need to do, what could happen, what the timeline could be, so they can really give you some insight into that, because we understand that is always a challenging situation to navigate. So again, I'm just going to cover here what PIDC would like to see, or any other lender. So you would sign an agreement of sale. That's something that we would want to see, that you have, an agreed upon price, and how long is your due diligence period. So how long do you have to actually close on the property? We would want to see all of that. And then we want to see some zoning approval. So are you going to be able to use the property as you intend it? So what if it's not zoned for your business use? That could be a major issue, and you might want to have that in the agreement of sale, that you're going to get zoning approval before purchasing the property. So we would be interested in that too. Some people, if they don't have their general contractor on board yet, they might just ask somebody to come in and do a quick property inspection of the space. If you do something like that, that's something that PIDC would be interested in seeing. Similar to if you were buying a house, you might want to, do an inspection. Now, somebody that's very versed in construction, you might just go ahead and take your general contractor, or maybe you yourself know a lot about construction and can do that yourself. But definitely think through, if this is not your area of expertise, bring somebody else in to see what's going on with the building. PIDC also typically requires environmental reports. We would either do an environmental screening for you, or we would typically recommend that you would do at least a phase 1 environmental report. That would just confirm that there's no major issues in the records on the property. So is there an oil tank? Was this property previously used as a gas station or a dry cleaner? That's something, those are things that are very common. You don't want to, PIDC doesn't want you to acquire a property that has enormous environmental liability, and that could cause you legal problems in the future, but also just you wouldn't be able to operate the property the way you want to. So that's something that's always important to consider. Typically PIDC or another lender would do the appraisal on the property. So that's not something that you would typically need to do. We would actually not accept an appraisal if you did it yourself. It does have to be bank ordered. And then obviously we do it, through the title company, there'll be a title search and report and all through the title process, and to see if there's any liens on the property. There's oftentimes, utility liens, even in the best of cases, there's at least that, but, just always want to know what else is on the property before you get involved. And then typically PIDC would be, there's a couple of different options here, which is that PIDC could help you acquire the property and our money comes in at the same day that you're acquiring the property. It's also possible that just depending on the project and you talk with us, that you acquire it beforehand and then we help you with the construction or renovation part of the project. So those things are possible and we usually work those out with each party. The next area is really managing the construction and the cost. So if you have a very complicated project, a very large project, you might actually go through several rounds of architectural drawings. So these are some words that are used in the industry. So I'm just throwing them out there because you might hear them. So sometimes folks come to us and say, I have conceptual drawings. This is really just drawings that an architect would do that doesn't have a lot of detail in it. And sometimes they're able to, you're able to obtain pricing from your contractor based on those conceptual drawings. Those price though are the pricing that you receive from conceptual drawings. We would recommend that you would put a large contingency in there because you haven't gotten into the details yet. So there could be something really major that you're missing. Like for instance, a conceptual drawing might not tell you if you need a sprinkler system, and a sprinkler system could like completely throw off your whole budget if you need it, right? So that's something that you wouldn't necessarily know early in that process. It's basically just like drawings. This is kind of the layout that it would look like. And then you get further detailed drawings. So the other levels are schematic, design development, and then you have your construction drawings. And with each stage, you could get refined pricing from a contractor to say, okay, here's these new set of drawings, can I get new pricing? Now, for a smaller project, you might move right to your construction drawings. These are also your permit drawings. And so you could just move right to those if it's a small project, and then you can use those to either get pricing, or you might actually want to go and bid out the project to several contractors to see how they would price it. Some of the programs that PIDC works on, especially anything public related, they might require certain bidding methods. So that's something to always check in on with PIDC before you bid. For instance, the RACB state grant program, it requires you to get 3 bids. Public, and so you have to show proof that 3 different contractors have bid on the project, and so that's something to keep in mind, and we can work help you through that process. So once you bid, then you get pricing, then you pick your contractor, and then you would sign what we would call a gross maximum price contract. So that would say like this, the price will not go above this amount unless you change the scope on the contractor. So the contractor is basically like guaranteeing you a price as long as you don't change the scope on them. So that's something to keep in mind. And that's definitely something PIDC likes to see, because we want to make sure that the contractor is not going to change the price on you in the middle of the project. And then obviously those construction permit drawings can also allow you to apply for your permits. PIDC would typically want to see that you have permits before we provide financing. So that's something to consider as well. Every once in a while, again, we could put money towards the acquisition and then wait for some of the money to be funded until you get the permits. And that's something we can work out. So I want to switch. I'm going to see how easily I can switch my screen, but I wanted to switch to an example of something in the industry. And this was sent out as a tool that you can use. So PIDC wants to see that you have your if you have a construction renovation budget, we want to see that in a trade list by trade. So that's things like plumbing, mechanical, roofing, carpentry. So that's like the way we would want to see it. So I've attached, again, to the email, and I'm going to pull it up here, an example. And like I said, let me see how easily I can do this. All right. Hopefully everyone is seeing. Lawrence, can you confirm that you're seeing an Excel sheet?
Yes, I am.
Okay, great. All right, so this is actually a construction pay application. So this is used throughout the construction project. The first tab is called the G702. It's where the contractor would write down, the contract sum. This is something that would be a part of your contract with the contractor. And then each time the contractor wants to get paid during the project, they would fill one of these out. And then you would submit it to PIDC for payment. But what I wanted to turn your attention to was the second tab, the G703, and these go together. And this would really detail the construction project by trade. So you'll see that, some of the titles are general conditions. This is things like, maybe setting up dumpsters, fencing, things like that just are needed to mobilize the site. This could also include, if it's a huge project, this could include a trailer. And then you have, again, the trades. So you have your site work, your masonry, you might have steel roofing, elevators, fire protection. You have, as you go down, plumbing, HVAC, electrical, and then typically the contractor would also charge for insurance, bonds, and permits. They actually pay for those and charge you. And then they're also going to charge an overhead fee. So those are like all common things. And we want to see that budget, this part in blue, broken down when we start talking to you. So we want to know that you've been at least talking to some contractors and have an idea of what it can cost. And the fact that you're getting into the trades and can price it by trades means that it's like a further along pricing, because typically a contractor, is only licensed in one or two areas of trade. So you might need to talk to multiple, the contractor would then talk with multiple subcontractors about the pricing. And again, this sheet is what would be used throughout the process as you submit for your payments as the construction project goes on. I think Marla also sent like a video out about this form, so you can learn more about it as you go. All right. All right, switching back to the PowerPoint, we're going to go to the next area, which is developing your budget. So this is also known as a sources and uses. So your sources are things like equity. How much equity are you able to contribute? And your sources also include loans. So you would talk to PIDC or maybe another lender about what their loan product options are and how much they would be willing to lend on your project. And then obviously determine if there's and then you determine your cost from the construction that we just talked about. You would add in some soft costs, think about that, and we'll go through a sources and uses template soon. And then once you do that, you think about, is there a gap, right? If there's a gap, just basic budget, balancing is that you either have to increase your sources. And this is a lot of times where people actually come to PIDC because their bank told them, okay, I can participate in 65% of the project, but maybe you as the owner only have 15% to put in to the project. So there's a gap. And that's a lot of times why people come to PIDC, because we could fill that gap. And sometimes people come to PIDC and even with those things, there's still a gap. And so we could help you navigate, like, are there any grant programs that we might know about that you might qualify for? Talk to the city commerce department, and we can work through that. Obviously there's also the possibility that you can find other equity investors for your project, especially if you don't have the 10% minimum equity to put into a project. So that's something to consider. And then a little bit about kind of just the process for obtaining your financing sources. So you would talk to a lender, typically apply for a loan. PIDC has an online application now. We've had some webinars about our online application. Once we receive that in a few weeks, we can issue a term sheet. And then in the term sheet, we would list all the items that we would need to finish the underwriting. We would underwrite your project and get approvals, and then issue a commitment letter. And then we would move to negotiating loan documents with you. You would do this if you had two lenders in the deal, like PIDC and a bank, you would do this with each of us. And then we move, once everything's settled and all the checklist items are completed, we would move to closing or settlement. So that's just the basic process with a lender. And that's why I was saying at the beginning, it's so difficult, as a developer to kind of manage all of these different things. Like you're talking to PIDC at the same, or a lender at the same time that you're negotiating with your contractor and architect, and at the same time that you might be talking with a tenant who's interested in leasing your space. And you can imagine that all of those things are informing each other. So it can be really challenging, and a lot of pieces are moving. So that's just something to keep in mind. PIDC definitely wants to help you through that process. We want to be your partner on that, but it's still a lot to manage. I'm now going to move to our second printout or attachment that we sent yesterday. And we will, let's see here, 1 second, sorry. All right, so hopefully this Excel sheet has really a range of uses, and it has a lot of different tabs, and we'll go through them, and hopefully it can be a source for you. So this is, you would again kind of enter in your sources of funds. Anything in blue is something where you would enter the amount, and anything in black is going to be automatically calculated. So how this is set up, and it doesn't have to be this way, but this is set up so that you put in your sources and anything left is equity, right? So like the black is automatically calculated. You don't have to set it up that way, but that's how this one is set up. So it just kind of lets you know how much equity is needed once you talk to your lenders. Then you get to the uses. You obviously have your purchase price, and we also have our hard costs. This could be just, okay, this is the quote I got, or this could be in trade, or this could be thinking about the different parts of the construction project. And, but then the thing I want to spend a little bit of time is the soft costs, because sometimes folks forget about the soft costs, and they could be a significant portion of the project. So you can see that this is a, $1 million project, and the soft costs are, $113,000. So that's like a pretty significant portion of the project, and you wouldn't want to forget about it. So your architect is going to need to be paid, any reports that need to be done. This one is like a little bit high because it's assuming that you had to have further reports completed. If you had a broker, I mean, these are all dependent on the project, but I just wanted to give you a sense of what is possible on a project. You would typically want to have enough money to pay your taxes and your utilities before you can occupy the space. So that's something to think about. How much time is it going to take me to occupy, and what are my holding costs before that time? You want to think about if you have to pay your lawyer, if you need some accounting help. Insurance is often something that's overlooked. And then we like to see a little contingency on the soft costs. And then there are financing costs as well. So that's something to consider. And PIDC and your lender can give you quotes on what the financing costs will be. Sometimes we require an interest reserve, which would be, again, how will this loan be paid in the period of time that you're not occupying it and you don't have leases yet. So that's always something that we'll be thinking about is, do you have the money to pay this loan while that is happening? A couple other things is that there are often furniture, fixtures, and equipment needed. This is especially true in residential spaces where you have things like cabinets and refrigerators. That's always something to consider, something to consider for your business. Do you need to buy all new office furniture for if you're moving, or are you able to utilize what you have? Sometimes folks charge a developer fee. This is especially if you hire a developer. That's always negotiated. It kind of depends. PIDC could put a limit on that. It's really more of a negotiation, and really depends on the situation. And then we really want to see, I have a 10% owner's contingency here. It depends what, at the beginning of a project, I really recommend 10 to 15%, just because you're not sure about the prices that you're putting, in the budget. And then after that, once you've refined the pricing, it could go down a little bit, but we would recommend it's typically never goes below 5. And so, but you would want to start higher before you know what all the costs are. Okay. Marla, do you want me to stop and take some questions? I don't see any hands. I know.
Sarah, I know you have a lot you want to cover. So
yeah. Okay.
let's just keep going through, and anybody who has a question, please make sure you're using the chat or use your raise hand function, and Sarah will slow down and get that information to you, or use the Q&A function. Okay, go ahead, Sarah.
Yep.
Thank you.
Okay, great. Cool. All right, we're going to go back to the PowerPoint. All right, I'm going to take a second because I know this is really of interest to talk about the different types of financing that you can get and the different types that you might want to consider putting in your sources. So obviously the first we've touched on a little bit is equity. So this is typically the terms of equity are that the payments to the equity owner are usually made after all other expenses are paid. So you would have to pay, you have to pay your taxes, you have to pay your utilities, you have to pay your lender, and then anything left you could negotiate to pay your equity investor. That might be you, depending on how this is structured. And there's also typically a negotiation around an IRR and a return, which would happen at the time of refinance or if you sold it. And typically you could take out some money from that process and your equity investor can kind of get like all their money back plus whatever IRR you've determined. Bank debt is your common banks in Philadelphia or nationally. And they're going to want to be what we consider senior or first position in the mortgage. So they want to be the only one, the first one with the mortgage on the property. And they'll have market interest rates and terms. Those used to be very low. They are going up. As you all know, we're in a rising interest rate environment. So it's important to talk often to your lenders to see what the current rates are. This is a good fit if your project is what we would consider like market rate rents in a neighborhood that has established sales and established activity, that they could look at those comparables and say like, yes, we understand these rates and believe in the project. They might also be interested in higher risk projects, but they would maybe participate at a lesser rate. So lesser amount. So they might not give you as much money as they otherwise would in a different neighborhood. So that's where sometimes you have to look at other sources. A lot of our smaller developers that are starting out go for hard debt. This is also sometimes known as internet lending. It's kind of all those other lenders that you see out there that aren't banks. And these tend to be higher interest rates. We've seen people pay anything from 12% to 40% interest rate, and they're short term, but they do offer you cash very quickly. And so I know that some people use them, especially if they want to acquire a property and it's requiring a really, really quick turnaround. That can be an option, but we definitely want you to talk to PIDC before you do that, because the problem is that if the project takes you a little bit longer, you're paying those high interest rates, and it could really cut into all of the profit that you have for the project. So we try to work with folks so that you do not have to take out the hard debt. And then obviously, again, you have the PIDC source, which is we can be senior or first position, and we could be your only lender. But often we're what we consider a subordinate lender or a second lien position. And our terms do vary, and we'll get through at the very end, we'll talk about our different loan products. This is a good fit if you have some sort of community or jobs impact, if you're in a neighborhood that does not have a lot of established comparable sales, so there hasn't been a ton of activity in the neighborhood that you're looking at. It also, if you any of the owners are a member of a disadvantaged population. Also, if you're just either expanding or retaining your business. So those are all things that PIDC is very interested in our mission. And then we can also help you through, or you can contact your council member or your state rep, or, even, your federal representative to talk about different grants that are out there in terms of government sources. PIDC is a conduit, we're a pass-through entity for some government sources. And again, we'll talk about some of those programs, but there are definitely others that PIDC is not involved with. Typically, those have some sort of public benefit. So either high job creation, maybe a cultural importance. And typically these are good if there is a large financing gap, but they do come with strings. So there'll be, again, maybe bidding requirements, construction wage monitoring, things like that you need to ask about, like what are the strings that those grants come with. All right. And then really the last thing we want to talk about with you at PIDC when you come to us for a loan is how are you planning for ongoing operations? So our loan with you is, going to be longer term. And so we want to know how you will be operating for the length of that loan and to pay us off. And we'll go through a performance example in our spreadsheet. So some things to consider are that if you have a lease, that lease must be as long as the term of the loan that you're looking at. So if you sign a 5-year lease, you're really not going to be able to take out a 10-year loan, because then we'll say to you, well, what happens in years 6 through 10? So that's something to consider when you're talking to, different tenants. Some of the items in the pro forma, they can be tough to estimate. How do I know how much maintenance is going to cost, or, snow shoveling? Some of those things, you could you might know based on the lease that you're paying right now. You might be able to talk to other people in your area, and they can also be verified in an appraisal. Although I tend to see that the appraisal shows them pretty low amount. So I always like to tell people to kind of estimate a little bit higher. We also like to see people put in a vacancy percentage on their rental. So if you think about, this especially happened during the pandemic, but people miss payments sometimes. Also, what if you have to release the space, someone leaves unexpectedly? This definitely happens for residential. We want you to put in a vacancy percentage so that you're, able to cover those types of things. And the budget isn't so tight that you need every payment, to make every expense payment and loan payment. We want there to be some wiggle room. I mentioned a little bit common area expenses, outdoor lighting, snow shoveling. Who's paying for those? You might want to put them in the budget. Maybe they're being reimbursed by the tenant, but they would then be in the budget in both ways. They would be coming in as revenue. They would also be shown as an expense. Maintenance, that's supposed to be and repair. I also want to say that sometimes people hire someone to manage the space for them. That's a great idea if you don't have the capacity to manage a space or, deal with residential tenants, depending on how many there are. You might just want somebody to deal with, getting tenants, signing leases, someone to call in the middle of the night if the toilet's not working. Maybe you don't want to be that person. You might want to hire somebody to manage that for you. If that's the case, you need to ask what that fee is and put that in your budget. And then we also talk to people about reserving for major improvements in the future. So you might want to put in something in your budget so that you're kind of like saving up as the years go, kind of putting stuff away so that if something happens to the roof or something happens to your, water line and you have a huge expense, you have a little nest egg that you've been setting aside each year. So that's always something to consider and something we recommend. All right, I'm going to switch back. And this time we're going to go to the pro forma operating projections. So this is just an example. This might not make a lot of sense for your project, but it's just an example of, you would see multiple years. So again, PIDC wants to see as many years as our loan exists. The rental revenue, other revenue, that could be revenue from parking, revenue from laundry facilities, that could be your reimbursements from those common area expenses that we talked about. And then you put in your vacancy that we just discussed, that could be anywhere from 5 to 10%. If you want to think about it, like, is this 1 month, that, or is it 2 months? Like, how many months might I be, without rent? And then you could think about that. So is it, what the percentage of that is? And then these are all of your operating expenses that we discussed. And then at the end, you would see what is your net operating income for the property. And then below your net operating income, you would see your debt service for your various loans. So here I've assumed that maybe you get an interest-only period for 12 months while you're constructing the space, leasing it up, or moving in. So the year 1 debt service is somewhat lower because you're not paying any principal. And then year 2, you start your fixed principal and interest payments. So you'll see that your net operating income is almost $76,000, but your debt service is nearly $50,000. So your net cash flow after debt service, is $46,000. That looks good the first year because, again, you're not paying any principal. But when you turn to year 2 and that debt service goes up, you actually don't have, oh, that doesn't look great. Yeah. Oh, and issue with the formula. Hold on one second, everybody. I will have Marla resend this out. And so it's so interesting because, all right, the debt service coverage was correct. So you'll see that you have very little net cash flow once the principal payments start. And what we call this is debt service coverage ratio. It means that you're able to cover your debt service with your net operating income just over 1 time, right? So this is something that a bank would likely want to see 1.35. So like you have net operating income to cover 135% of your debt. But PIDC can be more flexible, and we typically can go down to 1.1 or somewhere near that. So you'll see here that, this is something that we might be able to get comfortable with because it goes, you eventually get to 1.2 over the years. So that's something to consider, and something that your lender will be interested in is what is the debt service coverage ratio. This has some assumptions to help you. So you're saying like, well, how do you know what the rental revenue is? How does that number come? So in the assumptions tab, you'll see that it has some where you could put in like how much rent, per square foot rent there is, and how much the different per square foot expenses are. It also has a tab where you can amortize, you could show what the payment of your debt would be. So you could put in your loan amount. This is like something you could get online, but it's nice. I find it nice to have all in one sheet. So you can put in your loan amount, your interest rate, your amortization, and then, then it calculates the annual debt service for you and actually calculates the monthly debt service for you. And you can see what that is. You can also see if you would have, for instance, a balloon payment. So if you have a 20-year amortization, but it's a 7-year loan, then that means that the loan will act as if it's a 20-year loan in terms of the repayment, the principal repayment. But at year 7, you'll pay what we call a balloon payment or a large payment to pay off the rest of the principal. So that's something you can see. So year 7 would be month 84. And if you go down to month 84, you can see that your balloon payment on a $600,000 loan would actually be $453,000. So rather significant and something that you would want to plan for. So hopefully this sheet can be helpful to you. I know it doesn't work in all cases, but it could be a good starting point for something as you're putting together a projection, or at least show you the format of something that PIDC would be interested in seeing, and we want to see that you're planning for. All right,
Sarah, we have a question.
Okay.
Regarding the appraisal, do we have to use PIDC appraisers?
So, so that I was mentioning that the appraisal has to be ordered by either PIDC or the bank for it to be something that we'll be able to use. So in the case where there's a bank, we would be happy to use the bank appraisal that they obtain. Well, we would negotiate with the bank to share that with us. In the case where PIDC is the only lender, we would order it. So you actually wouldn't order it. It's not that we should tell you the appraisers to use. We actually ordered it ourselves, and we control that process. And we do have a list of appraisers that we use, and we do go out for quotes to get you the best quote and time. All right. Any other questions, Lawrence, that were in there?
No, that was the only one.
Okay, great. All right. Okay, so now we're kind of just putting it all together. So I'm going to talk a little bit about what PIDC would look for in our various checklists. So at the time of application, the first 4 items on this list are really things that represent your team. So org chart of your property owner. So who is going to own the property? That's something really for you to think through. Again, is it a special purpose entity? Are you the only owner of it? Or are you going to have like multiple people own it? What's the share? PIDC is going to be really interested in who owns that entity. We're going to be interested in if it's a business that's going to be occupying or it's related to a business, we're going to be interested in your current financials. If you're just a person, we're going to be interested in your personal financials and your personal tax returns. So that's something that PIDC will ask for. If you have previous real estate experience, we would like to see what we call a schedule of real estate owned. So this is where you would list out all of the properties that you own, how much money they bring in. Maybe you have some rentals. Do you have any debt on those properties? How much debt? So we have a schedule that we could send you if that applies to your case. That does not apply to everybody, but if you do have property that you own, we want to see a schedule of that. We want to see the bios or resumes of your team that we talked about, or your qualifications of your contractor. Do they have their licenses? What are their experience? Have they done similar projects? We know sometimes we see people, they want to use a contractor that they know who's done only single family homes, but they want to use them for an industrial renovation. That might not be a good fit, right? Because they might not have experience in that. So we would really want to evaluate that. The next item, we talked about the agreement of sale on the property. We would be interested in the schedule. What do you anticipate the schedule is for your construction project? How long will it take? Will it take 3 months to finish? Will it take 6 months, 18 months? That's something that we would want to know. We talk through the construction budget by trade. We talk through the sources and uses. If you were going with other lenders, we might need to see the term sheet from those other lenders so we have an idea of how they've structured the project. And we've talked about the letters of intent from third-party tenants, and then operating projections that we just walked through. So those are things that PIDC, it's a huge list, I understand, but it's things that we really need to be able to even to really issue a term sheet to you so that we can structure the deal and know, for instance, we need to know how long construction will take you, because we'll be able to use that to tell you how long of an interest-only period we can offer you. So these are all things that are really important to us as a lender and to structure the deal. The second checklist is all the things that we would need before we actually close on the financing, in most cases. So that would be, you might have a sense of who you want to own the property, but by the time we close, we actually need organizational documents. If you formed a new entity, if there is an operating agreement with the multiple owners, we need to see those documents. We would need, your bank account information, W-9. We talk through the zoning approval if that's applicable. We need the reports that we talk through, the environmental reports, the title report, title insurance, the appraisal, the leases, not just letters of intent, but the leases to be signed so that we know that they're fully negotiated, that you've talked through all of the fit out with your tenants, the construction drawings, all the construction items. So the drawings, the contract, and contractor insurance. and building permit. We often have someone go in and look at the building and review the plans and review the construction contract. We're not construction experts, so we usually hire somebody to do that. And that's typically a report that they'll put together for us. And then that same organization will inspect the property each time that you request payment for your construction project. And then we're also looking that you have property and liability insurance on the property. This is very important, especially if a property that you buy might be vacant for some time. You know, you think about what could happen to it while you're not there. So that's especially important. And then lastly, I just want to talk through, of course, what PIDC's products are. This is not a complete list of PIDC's products. I've tried to really just hone in on the ones that are applicable to financing commercial real estate. The first two programs, commercial mortgage loan and neighborhood development loan, are extremely similar products. They really mirror each other, except for one difference. If you are an operating business and you are looking to buy a property that you will occupy some part of that property, we're able to qualify you for the commercial mortgage loan product, and that has a lower interest rate. Right now, it's 4%. We don't change our interest rates as often as banks. We definitely don't change them every day. We typically change them quarterly, but we've actually been offering these rates for the past I think 2 years at this point. So they might go up, but we definitely don't change them as often as banks because we're not a bank and we don't have those types of constraints. But the commercial mortgage loan, again, is more for operating businesses who are purchasing. And then the neighborhood development loan is really more of a developer product. So if you're leasing the whole thing to third parties. Both have loan amounts between $50,000 and $750,000, and equity anywhere. You know, our minimum is definitely 10%. We usually like to see 20%, but based on need, you know, we would consider going down to 10. Term, again, it's based on a lot of different things, some of which is the leases, but term can be 5 to 15 years. And we are able to go amortization up to 25 years, which does reduce the annual payment. And our interest rates are fixed. So that's something to consider. We have another product for larger projects that can go up to $2 million. Those are typically more developer product. It could be either, really. We could go up for either project, but they usually have job creation requirements. They also usually have construction bidding and wage requirements. So there are some more strings on those, on the product that goes up to 2 million. And we typically do like to see the 20% minimum equity on that product. We're not usually able to go up to 25 years, but we can get to 20 years on that. And then the interest rate really varies based on the project that you have and some of the different aspects of it. But we usually are anywhere between 5 and 7% interest rate, and that is fixed. So those are our 3 loan products that we mostly use for real estate projects. I did want to mention, this is often asked, that PIDC does require completion and payment guarantees for all of our loans. So any person or company who owns at least 20% of the property will be required to guarantee. That's the standard PIDC policy. I wanted to touch on 2 products that you may have heard something about. They're usually relevant for larger projects, but I want you to be aware of them. The RACB grant program is a state program, and PIDC is a conduit for that program. So we don't make any decisions on who gets those grant programs, but you apply through us. So, you know, the paperwork is basically coming through us. Those are grants through the state. So that's, you want to contact your state senator or state representative to be considered. And those typically have like some type of impactful, are impactful to the state or the city or the region. They can be larger, they're 500,000 to 5 million, but they do require a match of 50%. So for instance, if you get a $5 million grant, which is rare, very rare, you would need to have a $10 million project. So you'd have to have, okay, sources of funds for the other 5 million. So that would be, loans, equity, anything. But you would need to have, the grant can only cover 50% of the project. And that's a grant. So there's no loan terms there. And then the other one is called the New Markets Tax Credit Program. It is a federal tax credit program, but it comes through PIDC, and we actually have more decision-making power once we're allocated tax credits. Lawrence and I work on that program. We typically look at projects with a minimum size of $4 million. It is somewhat complicated, but what happens is that it's an interest-only loan, and about 20% of the loan that you receive can be realized as equity after a 7-year compliance period is over. So it is a way to bring equity to the project, and is especially, it's very competitive. And so the projects that we seek are really very impactful to low income people, and they're in a low income area. And we look to measure how impactful those are directly to low income people. So not indirectly, not like, oh, this will raise tax revenue or something like that, but it's really like, I will be hiring low income people or be serving low income people specifically with this project. So that's something we're actually going to have a different webinar in June about new markets specifically, if that's something that you're interested in. All right, well, that is the end of the presentation. I wanted to leave some time for Q&A. If you are a developer, if you are a community development organization, and you want to talk to Lawrence or me about a project that you want to brainstorm, that's what we're here for. Please contact one of us. We're up here on the screen. If you are an operating business who's interested in purchasing property, you're going to reach out to our colleague Arthur Jimenez. His contact information is here. We all use the same products, but we have different areas of expertise. So Art is really great for talking through the strategies with operating businesses. So I will pause and answer any questions that folks might have.
Boy, Sarah did a phenomenal job. So this is a lot of information. And once you get it, you get it. And sometimes all it takes is for you to go through your first real estate project for you to really understand what has to be done. So don't be intimidated by the information. I see, let's see, we have a hand raised. Jason Wallace, do you want to ask your question? If you unmute your mic, Jason. Unmute your mic, Jason. Okay, Jason must be having challenges with his microphone. Are there any other questions? Remember, this information is, you typically don't get this kind of information step by step by step by step. And it is PIDC's commitment not only to helping you secure financing, but making sure that you understand the process. And so Sarah and Lawrence and Savannah take a lot of time holding hands of persons and organizations that have acquired real estate, because it can be daunting. Many organizations are expert in the delivery of their product and service, and all of a sudden, because they're so good in the delivery of their product and service, they think managing a real estate acquisition or development project is going to be a piece of cake. Not so. And so one of the things Sarah talked about in your soft costs are those professionals as a part of your team. And that should be hiring a project manager, someone who is going to work on your behalf to organize everything that needs to get done. these projects, Lawrence and Sarah, talk about how long some of these projects can take when you have a project manager versus how long they take if you don't have a project manager and you're doing it on your own.
Yeah, thanks, Marla. And I do see a few questions too, so I will answer them. You know, I think I go back to thinking about, like you said, what are the things that you are, you know, as a business owner or developer really good at, and then knowing what, you know, you don't have a lot of information in, and that's when you want to hire, you know, a developer, project manager, owner's representative, kind of all could be similar. I think that not just the time, you know, if you don't know, if you miss something like the zoning, that you didn't know was an issue, or you miss the fact that you needed a sprinkler, you're going back to square one, right? And so you're kind of starting the process all over. Going through zoning can take, you know, 6 to 9 months just to go through a zoning process. So if that's something you didn't know about, you know, just having someone on your team that did know about it could save you 6 to 9 months. And then you think about all the costs that you spent that you really have to redo. So that's, you know, something, you know, to consider. And again, you could always ask PIDC when you talk to us, like, do you think I need a project manager for this? Like, do you think this is complicated? We're happy to give that advice. I had 2 questions I wanted to answer, which is, one was, well, I still need zoning approval if I buy right. No, we just want to have zoning confirmation that it is, you know, you're buying, your use is by right? So we want to confirm that. So as long as that's been confirmed, and you definitely won't be able to apply for building permits if you don't have the correct zoning. So that's always something a way we can confirm it as well. But we want to get ahead of it and make sure that that is correct and it is by right. There's nothing there. The other question we got was, how soon into the development process should one seek to sit down with us? That is such an excellent question. I think we might, you know, I would say, like, it's never too early to talk to PIDC. It's
never too early.
Because the thing is that, like, and I hate to see this, but like we are a nonprofit. It's free to talk to us. Like, we're not charging by the hour. You know, even all the great people that you need to work with, your lawyer, your architect, they want to be paid for their money. PIDC is really fortunate that we're able to work with you, you know, regardless of like getting paid that minute. And that's really, you know, great. And so we can give you advice. It's possible that, again, so it's never too early. I would say, like, to get serious and for us to maybe be able to give you real direction on the type of loan we could go with, you need to have a property in mind, you know, like at that point, like you can call us before that. We'll help you through it. But in terms of us giving you very specific feedback about what we are going to be able to do and participate, we really need to know, like, well, what do you want to do in the property? Like, do you want to, again, go back to those questions at the beginning? Do you want to lease it? Does it need construction? You know, did you find the property? You know, what do you have in mind for it? At that point, we can really give you a lot of feedback.
So the information that you've heard Sarah present today, that's the information that Sarah and Lawrence are going to talk to you about when you come to PIDC. So if you come without having anyone on your team at that point, we're going to tell you, we think you should get this, we think you should get that. These are all recommendations. You don't have to follow our advice. We recommend you follow our advice, but you don't have to. But you will not typically get this kind of guidance without paying for it. So Sarah is absolutely right. Remember, PIDC is the City of Philadelphia's economic development organization. So we're not just some for-profit organization that's out here. We represent the City of Philadelphia. We are the economic development organization for the city. So it's in the city's best interest to make sure that as you are looking to develop, which increases the quality of life in your community, in the city, that we're giving you that subject matter expert advice. We are subject matter experts that are helping you through this. It will help save you time. It definitely will help save you money. And so as Sarah said, it's never too early, but I will say this, understand the kinds of projects that PIDC can finance. If you call us up with a few questions, we're going to try to get some idea of what you're doing. Once we have some idea of what you're doing, we'll be able to know first, is it something that PIDC can fund? And then if it's something that PIDC can fund, then Lawrence and Sarah will take you through what are the available financing options that we have. Other questions? Jason, I'm not sure if you're still on this call, but your hand is raised. If you can unmute your mic, and if not, I'm going to lower your hand. Any other questions? This is great information.
I see
also,
two more in the chat,
go ahead,
Marla.
Sarah. Yep.
Okay, so Erica asked about, some specifics about CMX2 zoning. I would say PIDC is absolutely not zoning experts. We're really just looking for confirmation that the zoning is appropriate. It's not advice that we're able to give, but the places that you could find that advice, a project manager, an architect, but also you could reach out to that Office of Development Services that I mentioned at the city. That is a decent question for them if you don't have anybody yet that's able to help you. But those are some folks that would have the expertise needed and the nuance about the zoning code in Philadelphia.
I put that information in the
perfect.
chat, and I just put it in again.
Perfect. Thanks, Marla. And then Darlene asked about, would we be interested in a certain project that she had? So one thing, I probably should have been more clear about is PIDC is a little unique in that we are really looking for some type of commercial aspect or non-residential aspect of a project. So we're an economic development entity. At the moment, we're really looking for there to be a non-residential part. So we would not at this time be considering projects that are 100% residential. We would be very interested in a project if, for instance, your business was, in the bottom of a building and you had apartments on top, or you're going to rent it out to a little retail entity and you have apartments on top. We're very interested in that, but we're really here for commercial activity and promoting commercial activity in the city. So at this time, that's really what we're looking for. I'm happy that, I think the information we provided today is really useful to residential or commercial development, but PIDC would really be looking for that commercial activity.
Questions? Okay, Jason. Great.
Yeah. Oh, you know what? I'm going to put the easiest way. Of course, you have our contact information here, but another easy way to contact PIDC is to fill out our inquiry form. And that just gets you in the queue. And we typically respond to inquiries within 24, 48 hours. So I'm going to put that in the chat as well.
Great.
And that can also get you to the right folks.
No question is the wrong question, or no question has an obvious answer. So don't feel shy about asking the question. We can guarantee you the more you know, the more prepared you are. Again, real estate is especially real estate acquisitions and development. And even if it's not a development project, you could be owner occupied and you've been leasing a project for years. And all of a sudden you want to purchase and do some renovations. All of this information that Sarah's talked about could still be relevant, and we can help you with that. So if you're owner occupied business and you're buying your property for the first time after you've been leasing for several years, we can still help you. But a lot of this information is still going to be the same. So don't be shy about asking questions. Better to ask and get your question answered. I see there is a hand raised. Michael, if you would unmute your mic. Go ahead, Michael. Okay, I can't hear Michael, but it looks like your mic is unmuted. Maybe if you put it in the chat, or make sure, I mean, it looks like it's unmuted, so I'm not sure why we are not hearing you. But please put it in the chat. Michael, we've got another Michael. Please unmute your mic and ask. Okay, Michael, you said your microphone is not working. If you just put your question in or your comment in the chat, Sarah and Lawrence will see it. Any other questions? It's 10:55. Sarah and Lawrence, are there other comments, departing comments that you want to make before we end? We thank everybody for coming out today. Again, this is the last time we did this was probably in the early part of 2020 or the end of 2021. I'm not sure. I know we did a big conference with PACDC, which we're also planning for the fall of this year. Keep fingers crossed that it will be in person. Here's a question.
Yep.
Okay.
I see the two questions, Marla.
Go ahead.
So from Michael, the question was, what is the approval percentage if all steps are followed for owner occupied? That's a tough one to answer because we don't really keep approval percentages. If you what I went through today is really what PIDC is looking for, which is, do you have a team that we feel confident in? Do you have revenue sources to pay the loan? Do you have enough sources of funds to complete the construction project? If those things are answered yes, then PIDC is interested in financing the project. Those are really the basics that we're looking for. And that's kind of why I went through everything today. Like everything kind of needs to work, right? Like you can't, we can't fund a project that's like, well, I don't have enough money to complete it. I don't have enough money to pay the loan. So if those things are really answered, that's something that PIDC is interested in. The only other thing, and this is related to Jason's question, can we go over the requirements for a likely project that PIDC will fund? Again, just the requirements are that these things all make sense. We do have, I mentioned on the financing page, we do have a 10% minimum equity requirement. I mean, and we are looking for projects that have a non-residential portion. But other than that, thankfully, we're not a bank in that we don't have, very specific requirements that we have to look at, specific numbers. We really are able to look holistically at the project. That's why I really went over things today, because if we believe in your team, that's very strong. And then we're able to, consider something else on the project that might be a little bit weaker. So we're really holistic in looking at the project. We're looking at every aspect, and that's how we underwrite. We're not like a bank where we have, okay, we can only do 65% LTV or something like that. That we're not like that. We can only do this if you have a certain credit score. We're not like that. We really are looking at every aspect of the project to see if it makes sense.
Yes, Sarah, if I can add.
Yep.
Each deal is different. So we have certain underwriting parameters, but there is flexibility. So if you're strong on one side, you may be weak on another. So, we need to talk it over. So it's best to always, give us a call, send an inquiry, and we can follow up.
Great. Darlene, we have a question from Darlene. Do you consider ARV of commercial property?
I I'm not.
We typically do not. So we'd have to look at the property itself.
Yeah. Oh, are you referring to, typically we would consider that to be, we would, yeah, I guess the answer is actually potentially yes. So when we get a appraisal, we could ask for two different values in the appraisal. So we could ask for an as is appraisal value, and we could ask for an as completed value of the appraisal, which considers after the renovations will be completed. I think that's really similar to after repair value, and we absolutely can consider that. Yeah, you would need to have, the appraiser needs to see what the renovations will be to be able to consider that, but that is something we look at, absolutely.
Oh, I apologize. I thought I was
Yeah.
responding to something about Airbnb.
Oh yeah, I know. I will say I typically don't use the term after repair value. So that was really helpful for me to hear. In the appraisal language, we've seen it typically as completed. I see another question. Can PIDC help with highest and best use scenarios? We certainly can try. We see some stuff in the market. We know a little bit about what's going on and what a community might be interested in having in their community. But I think we're not necessarily the best resources for that.
So what about market studies, Sarah and Lawrence? How often do we use market studies?
Yeah, it depends. I mean, I think market studies sometimes can offer a little bit of false confidence. I'm not sure that any study can tell you exactly the answer in terms of like what a rental rate will be, what you'll actually be able to get in terms of some uses, but certainly they can be helpful. I would say I would check in with the community group that the property is in first, because the community might have done some studies like that to see what is possible in that area. But oftentimes it's sometimes just talking with the market about like, the highest and best use is often what you are able to get, right? So like if you know a tenant that can pay a certain amount of rent, that's the highest use, and someone else might not be able to get that tenant, but you can, because you have that relationship. And a market study won't tell you that, because that tenant maybe isn't in the market. You have a relationship with them. So it's kind of a tough question to answer, but I'm trying to think. Lawrence, do you know any other resources that could help with that type of scenario? I mean, appraisal would, talking with brokers.
Yeah, the best thing we said is to speak to a developer. Sometimes or a broker as to the highest and best use, because if you want to compare it to what your plans are.
And one of the things that I've noticed, and I've said this for years to developers, is developers tend to rely on market studies. So they look at the revenue, the household income in a certain area, and they make assumptions about how people spend. And when you come into certain communities, those standards change. And so you have to be sensitive to the dynamics in a community, because just because the household income doesn't meet a certain standard doesn't mean that the people are not going to pay for certain products and services. So, for years, it's taken some minority communities to get a lot of effort to get supermarkets in those communities. It's not that minority residents aren't buying fresh food. It's that some of those market studies have said that household income is too low for their standards until the supermarket gets into the community. And all of a sudden, people are making money hand over fist. I remember the same thing was happening for those of you who remember when Target moved to City Avenue. We couldn't get Target in Philadelphia for years. And all of a sudden, when Target went to City Avenue, it had the highest grossing revenue of any opening Target in the country. And if you go to it today, I mean, it's so you have to be careful when developers use market studies based on household incomes, because different cultures spend money differently. Okay, it's 11:05. We want to thank Sarah Stroney, Vice President, Project Finance at PIDC. We call it internally Real Estate Finance. Want to thank Lawrence McComey, Vice President, Project Finance, Real Estate Finance in PIDC. I also want to give a shout out to Savannah Mudd. So Savannah, if you can show us your lovely face. Savannah is an analyst and administrator who supports real estate finance, an outstanding young woman who came to PIDC as an intern and works with us full time. Also want to mention Arthur Jimenez. Hi, Savannah. Also want to mention Arthur Jimenez. For those of you that I mentioned, if you are an operating business, owner occupied, and you want to do something with you want to relocate your business, sometimes the project for an operating business is larger than the division that Arthur works in. And so that project will transition over to Sarah and Lawrence. And so that happens also. So we just want to remind you, we've got 3 subject matter experts at PIDC, all supported by the outstanding Savannah Mudd. So when you have questions about anything, just as Sarah said, give us a call. You can call Sarah, you can call Lawrence, you can call Arthur. Here's all of that information. You can also find this information on the PIDC website. All right, so even if you forget it from here, just go to PIDC.com and you'll get all of the information that you need. So thank you all. We'll get the amended spreadsheet out to you, Sarah, with those change formulas. It's 11:07. We will see you soon. Make sure you're checking the PIDC website for all of our upcoming activities. Spanish speaking entrepreneurs, we're going to repeat this session. 2 parts, we're going to repeat it twice, once in the evening, once in the morning. It's going to be all Spanish with all Latino and Latina real estate professionals. So if you're in that group or you know business owners within that network, in your network, please let them know, go to the website, and we will see you on next week. So with that, if all hearts and minds are clear, this is time for the benediction, Lawrence. See you all real soon. Bye.
Bye-bye.